Hey, I'm Mike Gold and welcome to Learning Serious Wealth Strategies. Today we're going to be tackling a solution that's really interesting and can be really powerful for business owners. So if you're a business owner or you advise business owners, tune in, okay? Today we're going to be talking about a very advanced serious wealth strategy that's going to help you to manage and control the risk of your business. One of the biggest issues that I see most business owners face is they're trying to grow your business. You want to do all of these things, but there's all these pockets of risk. And it's really challenging because we take out insurance policies, but are you fully covered? And more importantly, not only are you fully covered, but sometimes traditional insurance doesn't cover all of your risks. And what happens if those things pop up? So another thing we're going to look at is how do we not only broaden our control of risk, but also how do we mitigate and reduce the business insurance cost or the premium costs, right? So it's not only just a matter of like how do we control all of these risks to make sure that we can grow our business, but it winds up costing lots and lots of money. Because anytime you take out another insurance policy to control the risk, it's more money coming out of your bottom line, right? So this is the thing that most business owners struggle with. It's like, all right, we want to grow, but we want to protect also. And the more we protect, we're limited because we're using capital to buy more and more insurance. So today we're going to learn not only how to manage and control our risk, but how do you bring those costs down? And lastly, in some situations, you may even have the potential to boost your personal wealth. So again, a recap, we want to manage, control our risk, again, build that moat around our business so we're insulated. We want to bring our costs down and we want to boost our personal wealth. So this is a strategy we're going to get into. It is not right for every business owner by any stretch of the imagination, but it's worth knowing that this is something that exists and to explore based on your numbers if it's going to even work. Now, what am I talking about? So let me get into it. So basically, we're talking about a captive insurance company. What is a captive? So many people tell me, like, Mike, I've never heard of this thing. What is it? Now, if you have heard of it, great. But I still want you to tune in because you may get some new perspective on how captives operate and how they might be able to work for you. And if you're totally green in this area and you haven't heard anything about a captive, I think you're really going to like this. So really all a captive is, it's a closely held business that you own or the business owner owns, and it's set up for the sole purpose. Its only purpose, the only reason a captive insurance company is in business is to insure the risks of the parent company. That's it. So you have your own company, the parent company, and then you own a separate company, which is known as a captive, and that captive's only reason for existence is to protect and insure against the risks of the parent company. All right, you with me? I'm going to show you how it works because it's much easier once you actually see it in motion. All right, so this is pretty much how it works. Okay, let me just pull out my trusty marker. I like blue, so we're going to go with this. So basically, how does a captive work? We have the parent company. Okay, so your company, whatever it is that you own, it might be a manufacturing company, it might be a garment company, it could be a service company, whatever the case may be, you have a company. Now, traditionally, what we do is we want to protect it. So we spend money to buy insurance policies at a traditional insurance carrier. So let's say hypothetically, again, this is just conceptually back of the envelope, just so you can kind of see how this lands. Let's say the parent company, between all of the insurance, the healthcare, the workers' comp, the general liability, directors and officers, errors and omission, on and on. Let's say all of those insurance cost $1 million. So they're out $1 million to protect against any of these things happening. Okay, so it's really simple. Parent company wants to protect against all these things, and they'll go to a traditional carrier. They'll pay premiums, and let's say those premiums cost $1 million. They take $1 million. The insurance carrier has the $1 million now. Now the insurance carrier, if something goes wrong here, they're obligated to pay based on the parameters of the policy. Now let's just say hypothetically there are $300,000 of claims throughout the year. Well, the way that it works right now, parent company pays $1 million to the traditional insurance company, and the traditional insurance company is paying back $300K. In essence, they're paying the claims. They're not actually paying the parent company, but in essence, they're paying $300,000 of claims. So $1 million out to protect $300,000. This is like standard operating procedure. And basically, the insurance company wins because the $700,000 that's left over, it's theirs. That's how insurance companies grow. Now, the issue is like, well, all right, well, what if we want some of that excess money? How does it work? Well, basically, we set up a captive. Now, a captive, this is an insurance company again, same owner. You own this one, you would wind up owning the captive. Now, instead of paying the $1 million to the traditional insurance carrier, basically what you would do is you would insure a portion of your risks to a captive. Now, why not all? Well, basically, we want to protect against catastrophic things like the plant went up in flames and it was more than the $1 million, right? So there's ways that we'd want to still have some traditional insurance for catastrophic, but let's say for easy math, we're still only going to be out of pocket $1 million. So basically, we would wind up paying $800,000 to the captive, okay? Parent company, $800,000 to the captive, and instead of the $1 million here, this would be $200,000. So $800,000, $200,000. You're still, parent company still out of pocket only $1 million, right? Parent company still gets a deduction for $1 million of insurance costs. All right, now the difference is this. If let's say the claims are still $300,000, well, basically the captive pays those claims, right? Because it's not a catastrophic thing, it's the same thing. So the same 300, sorry, my handwriting's a little bit messy here. So now the parent company took $800,000 to the captive, $200,000 to the traditional, okay? Still $300,000 in claims. $800,000 minus $300,000 means in the captive is $500,000 left over. Now here's the deal. A lot of people say, Mike, I get it, but like if I own the captive, now I have $500,000 of income that we'd have to pay taxes on. Well, here's the beauty of a captive, or just insurance companies in general. The excess is $500,000, or just like the traditional when they made the extra money. The way that the rules work is that is reserved for future claims, so it's not taxed as ordinary income. This is sitting in reserve. Now, mind you, if you do this for a number of years and your claims rate is low, like in this situation, it's $1 million out with $300,000 of claims, 30% claims, that's the ratio. If that continued for a number of years, the captive's building up $500,000, $500,000, $500,000, and you can invest the $500,000. You can put money markets, CDs, bonds, stocks, mutual funds, whatever the case may be. I mean, you're not going to be like day trading or anything, but you could build a portfolio and build it up and build it up and build it up. This is how traditional insurance companies have become so successful. So now you can take a page out of the playbook of the traditional insurance companies and have it for yourself. Now again, it's not right for everybody, so let's see why. First thing you have to do, you have to see what your exposure to risks look like. So this is a little exercise. I want you to just pause the video and walk through this. Just want you to take a piece of paper and list out every risk your business is exposed to. Then you have to see what your claims percentage is. In my example, it was roughly a 30% claims ratio. If you have high claims, captives might not be appropriate for you at this time. Okay, so you need to know that. Then you want to list out all of your policies, right? So I give some examples: general liability, directors and officers, errors and omission, workers' comp, healthcare. The list goes on. You can have product repair and recall. This is for like warranty issues. So depending upon your business, what types of policies do you have and what are they protecting? And just by going through this exercise, it can be eye-opening that maybe we don't have the right amount of coverage. And not that a captive is right or wrong for you, but just going through the exercise will identify, are there any gaps in your current risk management of your business? And it also lays the foundation to determine if a captive is going to be anything worthwhile exploring for you. All right, now before you get into it, because a lot of people get really excited about this, there's a few obstacles to be aware of. One I stressed a lot previously is if your business has a high claims history, captive is not going to be right for you now. Now, that doesn't mean it's never right for you. Like, things can progress. Like, you may have a few bad years. There could have been some things that went wrong from a risk standpoint. That can change, and maybe you can revisit a captive in the future. But currently, if you have high claims and you think you're going to continue to have high claims, you may want to pause this and look for different solutions. Okay, next, this is where I'm going to talk a little bit about advisors or professional experts giving advice on this. When I see advisors positioning a captive as something for like legacy planning, well, here's the deal. This is not a solution for next generation or transferring assets in a tax efficient manner. The tax code is always changing, especially with stuff like this. So if this is ever being positioned just as like an estate planning tool, hit the pause button. This is a strategy to manage and control your risks of your business, potentially reduce the cost of insurance, and if things go well, boost your net worth, boost your personal wealth. So there's a lot of moving parts, but those are the three main benefits of getting involved with a captive, not for legacy planning. So if it is positioned for you from a legacy standpoint, hit the pause button and get a second opinion. All right, then all on the advisors, qualified professionals. This is a more esoteric, advanced strategy. This is not for the novice advisor or somebody that just, read about this. You need really qualified people. There's a team of folks that would be involved to make sure that this is done right. So if you're not sure who this is, contact our office or send us a message, and happy we can walk you through, like, just to point you in the right direction. Now, lastly, a lot of folks think that this is only for large companies like Fortune 500s. It's not. All right, yes, a lot of big companies have these types of vehicles in place, but depending upon your numbers, there are many, many variations of captives. So the idea is you have to explore, you have to do what we call a feasibility study. And whether you're a small company or a massive company, if the numbers work and it lands for you, it could be a really powerful solution to, again, mitigate the cost of insurance, control your risk, and potentially boost your personal wealth. So again, I don't want you to feel like, this is only for the big guys. It's not just for the big guys. This could be for everybody, but you just need to know if the numbers work for you, okay? Now lastly, just a takeaway on this, captives are not right for every business. They're really not. But if you go through your specific numbers, you can really determine whether or not a captive will land for your business. And it's really only going through what I call that feasibility study with your actual numbers. You list out your premiums, right? You list out your insurance policies, all of the potential risks to your business. Work with qualified professionals who are going to look at this from a standpoint, well, is there a financial vehicle that this actually makes sense for your business? And if it doesn't, they'll tell you and you move on. And if it does, great, then you further explore about putting it into place. So it's not right for everybody, but look at your numbers, go through the exercise, work with qualified professionals, and see if a captive might be right for you. And if it's not, at least you know it's something that exists, that's out there. It's a really cool strategy. It's something that's a little bit, it's not that it's so different, but a lot of people haven't heard of these things in the past from their regular advisors. So if you are a business owner, and you learned something new today, great. If you already knew about a captive, maybe you got a little bit of a different insight or maybe some new perspective, and I really hope this message has served you. So my name is Mike Gold. Again, I look forward to seeing you out there, and I want you to remember, whether you're a business owner, advising business owners, or you're just tuning in because you like learning financial strategies, remember, consistently and always make smart, well-informed decisions around your money, because when you do, you're in a position to achieve your financial goals. And by achieving our financial goals, we enrich and improve the quality of our lives. We have more prosperity, more protection, more control over things, and that's really what it's all about. So I hope you enjoyed the video, and I look forward to seeing you out there. My name's Mike Gold. You make it a great day.